You're listening to Let's Talk Macro.
Brought to you by Bandhan Mutual Fund.
It's time for the much-needed macroeconomic rundown at the end of the month, thanks to us. Welcome to Let's Talk Macro, everybody. Ahalya here, keeping you company on the podcast all about macroeconomics by Bandhan Mutual Fund, where we discuss interesting global and domestic macroeconomic topics and events. We have with us, as always, Sreejith Balasubramanian, Economist in the Fixed Income Fund Management team. Welcome, Sreejith. How are you? Welcome back.
Thank you, Elia. I'm good. How's it going?
Going well, and I think we've got a very important topic of conversation today, so let me take a second to just set the context.
Okay.
So trade and tariffs are kind of back in the news again. We've been seeing headline after headline. You know, the US has been announcing potential escalations and then trade deals with various countries. Now, tariffs imposed by US and China on each other had briefly escalated a few months ago, but discussions for a deal are currently ongoing. And in the meantime, exports from China have picked up. So in today's episode, we're going to talk about the Chinese economy. It's been a while since we did that. We're going to look at the structural and cyclical elements, how it is placed on the challenges it has been facing, fiscal measures, and the outlook for the rest of the year. So, Sreejith, let's start with the basics. How is the Chinese economy placed now structurally, and on the issues in the property sector and consumption in general, which was where it was really looking bleak for a while?
Yeah, so we've discussed how consumer demand in China was weakening even before the onset of the pandemic. Property sector deleveraging was also happening. And then COVID period lockdowns were very stringent, based on the zero COVID strategy there. So combination of these factors hurt the economy, and the eventual economic reopening also in 2023, which was expected to release pent-up consumer demand, also disappointed. Now, if you actually take a step back and see, in China, home ownership rate is quite higher, and the real estate sector has a meaningful share in both GDP and government revenue from land sales and property taxes. So the economic linkages and impact of real estate is quite strong. And the consumers, therefore, were facing a negative wealth effect and weak income growth prospects. This has sort of been broadly continuing from when we last discussed about this. Although some measures have been taken, and the data has also bottomed out in some cases, but it sort of continues to remain weak.
Right. So the property sector and consumer situation continue to be weak, even though some data might have bottomed out. But Sreejith, let's talk a little bit more about that data front, right? How has economic data evolved over the last few years, and how is it looking now?
So China's real GDP growth has slowed from the double digits that we saw in the early 2000s and even the highest single digits in the last decade to around 5%. In fact, it was 5% last year. Growth in fixed asset investments has slowed down, and so has growth in overall credit and industrial value added. In the last few years specifically, if you see investment in real estate, data like area sold and under construction, property price growth, etc. have slowed. Consumption related data, again, like growth in retail sales, consumer loans, and consumer confidence have also weakened. A reflection of all this is the fact that the producer price and consumer price inflation have remained very weak for quite some time. So if you look at the PPI, which is the producer price index, that has been negative for over 33 months now. And the consumer price index inflation, CPI, has averaged, it actually averaged 0.2% each in 2023 and last year also, and it's currently at around 0.1%. So that's why we are broadly on data right now with respect to the property sector, consumer slowdown, etc.
Right. I mean, the data is continuing to mirror the weakness on the real estate and consumption sides, which is only natural.
Yeah.
And we do understand that there were measures taken, both monetary and fiscal. But to what extent has that helped the Chinese economy, Sreejith?
So monetary policy response was the first line through various interest rate cuts, lower bank reserve requirements, and so on. But markets were, even when we discussed last, were looking for bigger fiscal measures that to address demand, the consumer demand there. China has acknowledged this problem, and that through various forums, in fact, like the Politburo meetings and the Central Economic Work Conference that happens there. It called for proactive and counter-cyclical fiscal measures and the need to boost demand. It announced some measures to support the property and stock markets also, but not really big bang. In fact, issued special quotas for additional borrowing by local governments and longer-term special treasury bonds issuance. In 2024, last year, it launched the Consumer Goods Trade-in Scheme, which subsidizes replacement of identified goods like home appliances and electronics. This has done fairly well to keep retail sales buoyant. So fiscal measures in general have been targeted, not really big bang, and probably a bit more focused on the supply side.
Okay, so, that gives us a really good idea of how we got to where we are. But Sreejith, if you could take a minute to paint the picture of the here and now, how have the last few months been and what are the takeaways there? What are your predictions for the future, really?
So we've seen US imposing tariffs at flat reciprocal rates linked to fentanyl for China and on specific goods and sectors. So we also saw retaliation, right, for the escalation through tariffs and non-tariff measures also, like ban on export of rare earths, minerals from China, blacklisting of companies, and in terms of retaliation, some restricted sale of certain semiconductor chips to China for a while, and so on. Then there was the de-escalation period and the 90-day suspension that we are now sitting on for most heavy tariffs between US and China, which is on till, I think, 12th of August. So apart from the uncertainty, this kind of front-loaded the exports and therefore the growth for countries like China. And if you look at the US side of the story, also it tallies well, because even there, if you see the first quarter headline GDP growth was weaker, mainly due to a strong pickup in imports to the US. And but the data also tells us that China's exports to the US sort of fell from April. But if you look at the Chinese exports to ASEAN countries and Euro area, that was stronger. So there's some rerouting of trade happening as well. Now, as the trade truce with the US is on till mid-August, there could again be some pickup in exports directly to the US. But this is, again, all of this is mere front-loading of growth into the first half of this year, borrowed from the second half. In fact, the consumer trade-in scheme, which is mentioned, as supported retail sales, but it is actually more concentrated on the targeted goods in larger firms, and also a lot will depend on the future amount and coverage of the goods that are actually subsidized by the government. Higher fiscal support so far this year, again, we've seen higher borrowing, etc. That could also be a case of front-loading. So all of this sort of argues for a weaker growth outlook for China in the second half of this year.
Right. And, Sreejith, at this point, I think it's also important to understand whether we're already seeing this weaker growth outlook. Is it already showing up in terms of growth downgrades as well?
Okay, yeah. So that's a good question. So the IMF in April downgraded China's 2025 real GDP growth from 4.6% to 4%. The official government target for growth this year is 5%, which is the same as last year. With the property and consumer situation remaining weak and the exports likely reverting lower, China's growth should also moderate, right? And one interesting aspect here has been the currency. Now, although the US dollar is weakened, the Chinese yuan hasn't appreciated much. Now, this could avoid disincentivizing Chinese exports through currency appreciation in the current trade environment. And it could also imply continued support for manufacturing over domestic consumption. The weaker domestic growth outlook that we just mentioned is also a factor here. It has potential implications for currency and trade of, even other emerging markets which compete with China on exports and also import various goods from China. With high US tariffs on Chinese goods exports, the trade outlook being unclear, and China's overcapacity, as we know in some sectors, particularly at a time when domestic consumption is weak, this could support exports from China to other countries. So case in point here is Euro area. So you see the Euro has appreciated as the US dollar has weakened, and therefore the relative yuan weakness, ceteris paribus, supports more Chinese exports to the Euro area. So therefore, the point really is that China's growth and currency outlook has important global implications as well.
So, there's important implications from the moderate outlook for China. And with that, I think we've reached the end of the painting today. It's time for me to summarize the key takeaways. So first things first, China's consumer demand was weakening even before the pandemic, and the property sector was also deleveraging. Then came the zero COVID strategy, and with the strong economic linkages of the real estate sector, the consumers were also in a weak situation. So multiple data in the property sector and on the consumer side have been reflecting this weakness, and the consumer and producer price inflation, which has stayed weak for a long time now, is a prime reflection of this. The second point of note, responses were initially from the monetary side. Fiscal measures have been stepped up now, but more targeted in nature and a bit more focused on the supply side specifically. The consumer trade-in scheme, however, did support retail sales growth. And finally, more recently, Given the US trade tariff announcements, exports from China and thus growth have likely been front-loaded. Along with the trade-in scheme and fiscal support seen in the first half, this argues for a weaker domestic growth outlook for China in the second half. This and the recent moves and outlook of the Chinese yuan also has important implications for the rest of the world. That's pretty much it for today. A very important discussion, and I'm glad we spotlighted the Chinese economy for a second there, Sreejith. Thank you, as always, for being with us on the podcast.
Thank you, Ahalya.
All right, stay tuned, everyone. We'll be back with another episode of Let's Talk Macro very soon. Until then, bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.